We had some unfortunate news for Oracle stock investors as the stock price fell by nearly 7% on Friday on the back of concerns from investors about the company's lofty expectations over these next few years. So I'm going to discuss some of those details here in this video and what it could mean for Oracle stock investors.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Oracle stock fell nearly 7% on Friday, reversing the previous day's gains as the company sought to reassure investors of their long-term profitability of its AI infrastructure business. Remember, Oracle had been signing massive deals with OpenAI for billions and billions of dollars of new computing infrastructure, renting that it was going to supply the up-and-coming artificial intelligence company. Investors were concerned for a couple of reasons. Number one, investors were concerned that OpenAI would not have the money to pay Oracle because OpenAI is losing billions of dollars annually on its business. It's offering its products mostly for free, and it doesn't have enough revenue to cover all of its costs. And so investors are concerned that they wouldn't even have enough money to pay for all these huge agreements they're signing. Secondly, investors were concerned that Oracle has made these agreements and priced these deals at levels that's not going to generate profit margins that the company has delivered in the past. So it's offering big discounts to secure these big deals, and investors are concerned about that. So Oracle, it rents out computing capacity from AI chips in its data centers. So Oracle will spend the billions of dollars upfront to build these data centers optimized for AI and then rent the computing power that companies like OpenAI will use from those facilities. OpenAI prefers this instead of building the data centers itself because it can rent the space and it costs less to rent than it does to own. And so OpenAI is making that decision to rent or lease rather than own the infrastructure it's using for its computing requirements. So the company saying that these data centers would hit a range of gross profit margin between 30 to 40% by 2030. So the company unveiled the targets a week after the information reported that Oracle was renting out these AI chips from its cloud segment at a much lower average gross profit margin of 16%. Just 16%, which is less than half this 30 to 40% range that Oracle is forecasting. The company also increased its revenue target for 2030 to $166 billion from its already ambitious $144 billion objective it outlined in its most recent earnings report. And if it does indeed hit this target of $166 billion, that would be good for a compounded annual growth rate of 75% over these next 5 years. Oracle doesn't grow revenue by this magnitude. Historically, Oracle is growing revenue in the low double digits or high single digits. So a compounded annual growth rate of 75% over the next 5 years would be a significant acceleration from the company's revenue growth rate over the previous decade. So partly that's the reason why Oracle shares have exploded this year. And if you remember, for the first, I want to say 8 months of the year, I had Oracle rated as one of the best stocks to buy. I identified Oracle as an excellent company, up-and-coming, accelerating revenue growth. I identified this late last year. And so I informed investors that going into 2025, Oracle made for an excellent investment, an undercover investment in artificial intelligence that hardly anyone noticed coming into 2025. Oracle burst onto the scene here in 2025 as it started reporting its financial performance, as it started reporting that it's getting these huge deals and its remaining performance obligations and order backlog had been soaring. Then investors started to take notice of Oracle, something I had already noticed late last year. Overall, the risks for Oracle have increased meaningfully in this run-up, as you might say, because some investors, rather than taking this as a potential opportunity for Oracle to increase its revenue over these next few years, some investors have just said, okay, for sure it's getting this, right? And I never took that conclusion. I always understood that these contracts are contracts where there is an agreement and there is likely cancellation fees, etc. But this is something for the future, and nobody knows what's going to happen in the future. It's never 100%. And so investors need to consider that when making decisions about this company and about the implications surrounding the profit margins, etc. Now, I'm not surprised. I wouldn't be surprised if Oracle's profit margins are not as large in these big deals, because in most cases, when you purchase a large amount and you agree to many years of agreement of supply, you're often given a discount. Otherwise, why would you want to make that agreement for 5 years and for these many billions of dollars if it's not also getting you a discount for making that deal? So I'm not surprised with that arrangement. I wouldn't be surprised if their margins are indeed lower on these big deals compared to their historical margins. They don't have the kind of negotiating power, that differentiation that a supplier like Nvidia would have, because Nvidia's technology is arguably one or two steps ahead of the competition, so they can command the price premium, and their customers are willing to pay that price premium because they can't replicate what they get from Nvidia from anyone else. Whereas companies like OpenAI can replicate what they get from Oracle from other providers of cloud services. And so Oracle, in order to win contracts, they have to give favorable terms. They have to give something in order to secure those contracts, which OpenAI can go to other providers for. They can go to Microsoft, they can go to Alphabet, they can go to Amazon, they can go to other cloud service providers and secure the computing power if they don't like the terms they're getting from Oracle. So Oracle needs to make a compelling case to win these contracts. And it's not always based on price. These companies oftentimes will make purchases where price is like the third or fourth most important thing. Reliability might be more important. Other terms of service might be more important than price. And so it remains to be seen what these margins are. Of course, we'll know more about this when Oracle reports its next quarterly financial results. I'm almost certain that the analyst that will participate in that conference call will be asking Oracle about the margins on these contracts it has over these next few years, the average of the margins of its remaining performance obligations. Of course, that will also depend on the cost to build the infrastructure, because Oracle does not yet have the infrastructure it needs to supply what OpenAI has purchased or what it has purchased in backlog. So it needs to build in order to serve these contracts. So a lot of risk involved here. And understandably, Oracle stock will be volatile. And it's one of the reasons why about a month or two ago, I took Oracle off my list of best stocks to buy. Because coming into the year, it was unnoticed. The valuation was ridiculously cheap. And now the stock price has increased significantly. And the market is pricing in these excellent prospects. So I still have it rated as a buy. It's just not one of my favorites any longer.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.